As an accountant with a specialism in tax and having worked for a busy real estate tax team in London, I wanted to share how you can pay less income tax on your rental income, because real estate is one of the most widely held assets among investors. There are some things that you can do to pay less tax on your rental income. So I'll cover how tax write-offs work for landlords, which write-offs you could be claiming, and an alternative structure for holding rental property that could save you tax. So first of all, what's a tax write-off? A tax write-off is an expense relating to your rental property that you can deduct from your rental income to reduce your tax liability. So let's say that you earn 24k a year for one rental property. If you're a basic rate taxpayer, your tax bill would be £4,800 on that rental income. If you claimed all of the tax write-offs that were available, say that they totaled £6,000, your taxable income would be reduced to £18,000 and your tax bill would be £3,600. So you've had to spend that money on your rental property anyway, but the UK tax rules give you some tax relief on eligible expenses that relate to your rental property. Let's talk about which write-offs you should be claiming. This isn't a full list, but it includes some areas where the rules have changed or areas where people typically underclaim. Investors will know that the mortgage interest deductibility rules are now much less favourable than they used to be, because in 2017 the rules changed. Before 2017, you could deduct your mortgage interest in full from your rental income. But now the relief is capped as a 20% credit of the mortgage interest that you pay on your rental properties. So you still get some tax relief, but it's a lot less generous than it used to be. It doesn't actually affect basic rate taxpayers, but if you're a higher rate or additional rate taxpayer, then you are worse off now because you're not getting relief at 40% or 45% like you used to. Number 2 is mileage costs to carry out landlord checks. If you're a landlord and you're travelling to and from your rental properties to carry out inspections, or you're going there for any reason relating to the tenancy itself, then the cost of your mileage is deductible, which a lot of people don't realise. But you do need to make sure that you're keeping a log and a record of your mileage to be able to claim the expense, so that you don't forget about it when it comes to completing your tax return. Number 3, replacement of domestic items relief. This write-off lets you deduct the cost of any movable items that you need to replace in your rental property, not buy for the first time. So if you have something that breaks or doesn't work as well anymore, say it's a fridge or a freezer, a carpet, a rug or a bed, then the cost of replacing that item is a tax deductible expense, which means that it is a tax write-off. Beyond this, the rules change, because if you replace something that's a fixture, say it's a shower, then that could actually be classed as capital expenditure and it would not be available as a tax write-off. Number 4, miscellaneous expenses. Don't forget about cleaning costs that you have to pay for as a landlord, ground rent, service charges, tenancy finding fees, and other agency costs, which are all eligible as tax write-offs. With all of these things, it's just really important that you're organised and you keep a log of all the expenses you're incurring throughout the year, so that when it comes to completing and submitting your tax return, you are not underclaiming on all those expenses that you've already paid for in relation to your rental properties. But I have to say that, as with all tax rules, there are nuances. So make sure that you consult your own tax advisor to understand which costs you can actually write off in your tax return. Now let's talk about an alternative structure to buying a rental property. So far, we've been talking about owning a rental property as an individual landlord, but the alternative is to buy your rental property through a company. And this has been a growing trend since late 2021, mainly because of those mortgage interest rules that we spoke about earlier. So if you're a landlord who's a higher rate taxpayer and you have a mortgage on your rental property, then you'll be paying fairly high interest rates, but you won't get the full tax deduction for that mortgage interest. That's when it may be better to buy a property through a company, because the company can deduct mortgage interest in full from rental income. And if you're a higher or additional rate taxpayer, that could work out more tax efficient. And then also, corporation tax rates are lower than income tax rates because they range from 19% to 25%, whereas the income tax rates for a higher and additional rate taxpayer are 40% and 45%. It's true that when you've got a company, you've got 2 tax points, because when the company makes a profit, it pays corporation tax. And then when you take the money out of your company, you pay tax again. But it can still work out more tax efficient for some people to buy their properties through a company. And I'll show you how with a quick example. So let's say that your company's revenue is £24,000 in a year, and it makes that through a rental property. And the mortgage interest on that is £12,000, which is deductible. And then you have other costs of £5,000. So your taxable income is £7,000. The corporation tax rate would be 19%, and so your tax bill would be £1,330. You would have £5,670 remaining. As a higher rate taxpayer, you would pay around £2,268 of tax on that if you withdrew it from the company. So your total tax bill would be around £3,598. That includes corporation tax and income tax. Now let's say you have the rental property in your personal name, not through a company. So you earn your £24,000 of rental income and you deduct your £5,000 of expenses. So your taxable income is £19,000. You then pay £7,600 of tax as a higher rate taxpayer, and then you receive your 20% credit on the mortgage interest. And the total tax you've paid is £5,200. So you can see with this example that it was more favourable to own the rental property through a company rather than individually. In reality, it can be more expensive and an administrative burden to have a company, because it means you have to file a corporate tax return and you have to file company accounts. And there is a cost associated with that, as well as with setting up the company in the first place. But it could be a better option if you are looking at buying a rental property. Thank you for watching. If this video was helpful, then please do share it with somebody who invests in rental property. Subscribe to the channel if you haven't already, and I will see you next week.